All right, everybody, we've got Brad live in the room here. So, Brad, you can go ahead and take it away. The next 30 minutes, the room is yours.
Okay, so everybody can hear me okay now? Great. I'm sorry, for some reason my headset wasn't working, so I'm going to be on phone. All right, so we're looking at a chart right now in the QQQ daily. That's an ETF for the NASDAQ 100. I made this yesterday, and I just want to show it because it's one of the ugliest charts I've ever seen. For the since the first of the year, just very range-bound market. Really points out that this is a kind of a trader's market right now. I'm Brad Powell. I'm with Right Angle Trading. We develop trading systems, and our real focus since the advent of leveraged ETFs has been on ETFs. And I'm going to talk a little bit about today's ETF market, and I'm going to make a couple of points. And one, that for short-term trading, we like ETFs better than stocks because it allows you to just focus on a few markets that have good, consistent price movement. And that leveraged ETFs, and I'm not talking about like the SPY, the unleveraged ETFs, the old tracking stocks, spiders, SPY, the Qs, things like that, but leveraged ETFs are horrible investments. They're really not designed for investing, and I'll very clearly demonstrate that and point that out. But they're phenomenal for short-term trading. I also just quickly want to thank Morgan and the people at TradingPub. I love these events. I love seeing what other people are doing, and part of our continuing education as traders. I just bought, I'm like a system buyer. I love taking other people's courses to see what's going on in the market, to know what other people are doing in the market, because I think it makes me a better overall trader to know what other people are doing and what might be impacting the market. So I want to thank Morgan and TradingPub for having me back today. So I'm going to quickly go through a little bit of information in general about ETFs. Those of you who may have seen some of my ETF webinars in the past, the first 5 minutes you've probably seen. After that, I have a lot of new information. I'm going to show you guys some specific tricks from my charts and especially get into trade management and stop adjusts and things like that on leveraged ETFs, and I'll show you some tricks on that and some indicators that can be very helpful based on what we do, and hopefully you can learn something from that and apply it to what you're doing. So exchange-traded funds, or ETFs, are investment funds traded on a stock exchange as tracking stock for an index sector, commodity, currency, bond. Virtually anything you can imagine now, there's an ETF for it. Its valuation is based on a combination of its net asset value and market fluctuations based on supply and demand. And when we look at some of the specifics of an index tracking stock compared to a leveraged ETF, you'll really see how that affects its NAV versus simple market fluctuations on supply and demand. Index funds originally launched in 1993 as index tracking stocks, or spiders. They were the SPY, the DIA for the Dow Jones Industrial Average, Qs for the NASDAQ 100. Those do not have leverage, and they're known as what's passively managed. They're just simply going to track the index. In 2008, the SEC made a big change, which was approving active management for ETFs, and that allows a fund manager to go in and gain leverage through derivatives such as futures, options, and bonds. Early on in the ETF market, there were actually quite a few problems with that. I remember the FAZ and FAS, which were the triple leveraged ETFs, debuted at about triple leveraged ETFs for the financial sector, debuted at about, I believe it was $200 a share, and they both went to $50 a share because they just didn't have a good grasp on what their management was at the time. So they didn't correlate at all to what the financial sector was doing most of the time. So it kind of took a few years for this active management of the ETFs to really find itself and really get good as far as which options or bonds and futures they were using to gain the leverage. And most of them, the ones that have survived and that we trade now, do a pretty good job of it. But you'll see that over long term, they're really not good investments because of options decay and that type of thing. There's currently over 1,400 ETFs and ETNs. The difference between an ETF and an ETN is an ETF is getting leverage through futures and options, whereas the ETNs are gaining their leverage through bonds and sheer debt. So ETFs represent currently, actually now it's about 40% of daily market volume. It's actually gone up from 35%. So a huge amount of the daily volume that we see in the markets is traded in ETFs. Quickly, some of the advantages of ETFs. You have an exposure to a broad range of index sectors and commodities. It gives you a range of leverage, allowing you to select a product based on your risk tolerance. So you may not want to trade a triple leveraged ETF. You may only go with a double leveraged ETF or go with a tracking stock, which is unleveraged, depending on your own personal preference and your level of risk tolerance. And where we feel like ETFs may be superior to stocks is, one thing is they can't be halted, and they're not as prone to these huge gaps that a stock like, say, Apple could have after an earnings report, or Intel, or, stocks are very subject to news individual to that stock. So even though that may, for example, when Apple opened down $50 after the last earnings report, yes, that impacted the NASDAQ 100, but on the same day you also had Netflix, which was up 30%. So it helped balance it out, so there was limited risk in the leveraged ETFs for the NASDAQ 100 as opposed to really getting whacked 10 or 12% if you ran an individual stock like Apple. And they cannot be halted on news, so you can always get in and out of these. Inverse ETFs allow short exposure in retirement accounts, which is huge for those of us who trade. I trade them in my retirement account because you can go long the inverse ETF. So technically, we're always going long something. We never actually take short positions. Using inverse ETF to gain short exposure, it's going to go up when the markets go down. For the most part, at least, the ETFs we trade are highly liquid with consistent volume. And there's low costs associated with trading ETFs as opposed to options or futures, because commissions are very cheap. Whether you're trading 100 or 1,000 shares, it's going to cost you the same. And usually you can chart it. Ameritrade has very good charting now through Thinkorswim. There's free stock charts. There's a couple of different places where you can get pretty good charting for free. So you don't have to have a very expensive platform to trade ETFs. Any broker that allows trading of stocks allows trading of ETFs. The only thing to be aware of is margin requirements are often different, especially for the leveraged ETFs. They're not going to allow as much margin for the triple leveraged ETFs. Disadvantages of the ETFs are really large opening gaps in leveraged ETFs. And a good example was from October 2011 to February 2012. The S&P 500 rose 12%, but 8.6% of that rise was all contained in the opening gaps. That didn't leave a lot of follow-through intraday for trading, so you just had to be on the right side of those gaps. Inverse and short ETFs have no bottom. And actually, you could technically say the same is true of long ETFs, but you see it much more in short ETFs. And by that I mean you can't take that stock trader's approach of, wow, the TZA, for example, which is triple leveraged short ETF for the Russell 2000 is at $4. That's cheap. It's got to go up, right? Wrong. They'll just conduct a reverse stock split when it gets down to a price that is not attractive to institutional buyers, and where 1 penny change can actually, or 2 penny change can actually be kind of a large percentage gain or loss. So they put on them. So one day you own 100 shares. Usually they do it at a 10-to-1 ratio. One day you might own 100 shares at $5, and the next day you own 10 shares at $50. Well, obviously that can go straight back down to $5 if the market keeps going up, or if it's poorly managed by the fund managers who are doing the active management in derivatives. And so you can fall into this kind of bottomless pit and end up with one worthless share over the period of a year or two. So it's always to be aware of that you need to keep an eye on the ETFs and see they announce that they're going to do these reverse splits. It usually happens when they get under $10, and you see it a lot in the inverse ETFs. Some of the other disadvantages that may not properly track the underlying index sector or commodity due to supply and demand in the open market or the derivatives used for leverage. The classic example of that was the natural gas ETF, UNG, a couple of years ago. They were way out in futures on options. And while natural gas prices rose 15%, the UNG went down 20%, simply because their net asset value was declining as opposed to rising because of the derivatives they were using. And you'll see that in a lot of ETFs, not that dramatic, but you see it all the time. Just decay over time based on which derivatives they're using. And individual sectors and commodities can kind of come in and out of play within consistent volume. And that's something to be aware of. We as traders like very liquid, consistent volume and price movement in ETFs, and not something that suddenly is going to dry up like what happened to the real estate ETFs a couple of years ago. The leveraged real estate day trading 10 or 20,000 a day, and you could get stuck in a position or simply just not trade it anymore. So we like things that don't necessarily do that. So I'm going to illustrate my point that leveraged ETFs are terrible for investing by this simple fact. If you bought SPY on the first trading day of 2011 at the close for 127.05, yesterday's closing price of 151.91 gives you a nice for 26 months. Now the SPY pays a dividend. I think it's 2.35% a year. You add in the dividend payments for a total return of 23.71%. So your triple leveraged ETF should return 71.11% over that period of time. So if you bought the UPRO on the first trading day of 2011 instead of the SPY for 70.29, yesterday's closing price of 105.88 is only a 50.69% return, and it paid a whopping 2 penny dividend in that amount of time. So where you should have gained because of the leverage, 71.11%, you only gained 50.69%. And that to me is a terrible investment. And more importantly, if SPY and the S&P 500 had been down 20%, 23% for the year, I guarantee you the UPRO would have been down a lot more than 71.11%. It probably would have gone down and reverse split and gone down, and it probably could have easily wiped you out. So when all is said and done, we say leveraged ETFs are bad investments, bad long-term investments. SSO, just somebody asked about the SSO, which the double leverage, the SSO underperformed the SPY as well, not by as large a percentage. The SSO is probably the best actively managed ETF out there in our opinion. It tends to track extremely well at 2 times the SPY, but there is always going to be some type of decay in its net asset value because of the derivatives. So it didn't quite give you that 46% return. I think it was like 42%. But so while these are bad long-term investments, so you'd be better off just buying more shares of something like SPY, collecting the dividends. And so we're not saying this about the index tracking stocks, but as far as leveraged ETFs, we feel like they're terrible investments, but they are awesome for trading because in the very short term, that just simple supply and demand in the market can actually make them go up more than they should in a 2 or 3 day period. So if the S&P 500 in 3 days goes up 4%, the triple leveraged ETF might actually go up 15%. So you actually get an advantage before that decay kicks in. So our criteria for selecting ETFs to trade: intraday, we like high liquidity, consistent volume, consistent intraday price movement that's not all in the gaps, and we like ETFs that trend consistently, markets that trend pretty consistently. For swing trading, high liquidity, consistent volume, and again, avoid excessive overnight gaps. So I'm going to show you a couple of examples. And I will say the bond ETFs, I think, are actually, if you're interested in long-term bond investing, I am not a bond investor. I don't pretend to be a bond investor or a bond trader. But I did a comparison of the TLT compared to a couple of bond funds that I follow that are very good bond funds for, actively managed bond funds that return about 5.5, and they're very conservative, 5.5% annually. A lot of investment advisors use, I forget the name, there's one out of Phoenix, and their average return over the last 20 years has been like 5.5%. Well, I compared the TLT, and with the dividends, because it pays a nice dividend, it actually was a pretty good long-term investment in bonds, despite the recent decline. If you had bought it 5 years ago, you'd actually be doing really well in the TLT, or 3 years ago, because it pays a nice dividend. But from a trading perspective, we don't love the TLT because of fluctuations in volume. And it's very clearly demonstrated here. Look at these huge fluctuations in volume. And the other thing we don't like is it's kind of tied to the U.S. dollar to a certain extent, which can have a huge move overnight. And so you get these unbelievably large gaps in the bond market overnight because they will react to what's going on in Europe, what's going on in Asia, what's going on with the dollar overnight. have these huge opening gaps, and a lot of days you don't have much room left for trading, either on an intraday or short-term swing basis, and it's just a little too gappy that you can really have it go way past your stop loss. So that's something we don't actually like to trade. This is the EPI daily, which is an India ETF, and again, this is something that we don't trade for short-term swing trading or intraday trading or long-term swing trading. If you want to invest in the India markets long-term and you think over the next 20 years the India market's going to show growth, then this is a good way to do it. But from a trader's perspective, the India markets are open when our markets are closed, and so most of the daily move is going to be in the gap. And that's why we prefer for emerging markets the actual emerging markets basket, which is the EDC and EDZ, which I'll get to in a minute, because the South American markets, which they're heavily weighted to, are open when our markets are open. This is the DDA daily, which is the agriculture ETF. What we don't like about this is it's seasonal. So huge volume last summer when we had the drought and the corn ETF was shooting up. But then when you get into the winter, it's just dead. There's really no trading. And again, a lot of its price movement is actually before the U.S. equity markets open, at least in the futures, the agriculture futures, because they're so actively traded before the U.S. equity markets open. Is in these opening gaps. So, if you want to jump in the summertime when agriculture prices rise, if there's a drought or short, if there's, it looks like there's going to be a huge supply of corn and wheat because of a good year, I don't really follow the agriculture markets, whatever drives the price, or, short because of seasonality, it's fine for longer term, but not something that we're really interested in trading on a regular basis. So our ETF favorites intraday are TNA TZA, which is triple leverage Russell 2000, EDC EDZ, emerging markets, UCO SEO, which is oil. It's double leverage, trades like it's quadruple. It's crazy, but it's a good trader intraday, and short-term swing. UPRO SPXU, which is the triple leverage S&P, especially for intraday and short-term swing trading. AGQ CSL, double leverage silver. ERX ERY. Which is actually has become our favorite triple leverage energy sector. And I'm actually going to show you some trade setups and how to manage a trade from the ERX, ERY in just a minute. FAS, FAZ, triple leverage financials. And then for swing trading, and I'm talking about longer term swing trading off of daily charts, we like to reduce our leverage there to protect against gaps. So the double leverage DPS, DDM, QLD, SSO, those pairs for the primary markets. We still like to stay in triple leverage for the ERX, ERY, and the financials, FAS, FAZ, and the emerging markets, and then the UPRO and SPXU again for shorter-term swing trading for 3 or 4 days as opposed to the SSO SDS. But when we go daily off a daily chart, we go into the SSO SDS. And really, if you just look at those pairs that I just gave you, it's a lot. They always have consistent prices. They trend pretty well, and there's really no point in having to search for anything else because these are going to give us enough trading opportunities. So when all is said and done, we believe the leverage ETF should be traded, not invested in, and be approached with the trader's mentality. Limit initial risk. Move your stops quickly. You have to protect your capital with them, especially in the triple leverage. We don't care if we get an exit signal, take the short-term exit, take our profit, and then look for reentry possibly in the opposite direction if we have a signal that way, or in the same direction, we'll get a trend continuation signal and we can get back in. I'll show you some specific examples of that in a second. And diversify. And by diversify, I'm not just talking about markets and sectors, but also time frames. And accept a speaker trades because of very good stop management to be in position for the big winning trades. And I will tell you, we have an intraday ETF alert service that we introduced a couple of months ago, and it's not even on a website yet. We're just doing it with existing clients for the time being. We're going to be opening it up, and I want to compare a trader's perspective with the UPRO SPXU to what we looked at earlier about the SPY. And I'll tell you that our trades run at about a 65% win rate, but we traded about a 3.5 or 4 profit target or net profit compared to loss. So our reward to risk ratio is about 3.5 to 1 to 4 to 1. We approach it very short term, sometimes only in for the day, sometimes in for 2 or 3 days. But our trading methodology produced over a 2-year period, non-compounded or 26-month period, about a 245% return as opposed to what we saw if you just bought the U-Pro and held it for that same 26-month period of 50%. It's been a very strong bull market most of this time, so you catch long trades that you stay with. We get some very big winning trades. You get a couple of small losers here and there. And it's about 5 trades a month. And, we send these signals out via SMS, so text message to your mobile phone and via email. And how we achieve that type of returns, and I say this to everybody, what we do may not be right for you. Our trading methodology, I'll show you what our trading methodology is momentarily, may not be right for you, but the one point I want to make about leveraged ETFs is to approach them with a trader's mentality, and that means limiting risk and moving your stops quickly and protecting profits. And I'll show you exactly what I mean by that. I'm going to jump over to a live chart. So this is the ERX Triple Leveraged Energy Sector ETF. On my chart, I'm going to go over what indicators I have. The purple, the magenta lines you see out here, and these are awesome for trailing a position, looking for exits, is to use these indicators. This is the Keltner channel, the outer bands of the Keltner channel at 2.5. The dotted yellow lines are a Keltner channel at 1.25. And then the green indicator is a 20-period EMA. When a market is trending strongly, the 20 EMA is often an area of support and resistance, and we'll see that as we go through this chart. And the midline of the Keltner, which is 20-period simple moving averages in blue. And this is a stochastic down here at our settings that we teach in our courses at 533, which is one of the momentum indicators we use. We also on our charts have another momentum indicator and 2 trend indicators of proprietary settings that allow us to measure trend strength and momentum. So when we're looking for trade setups, we're trading based on divergence. We're looking for our trend indicators to tell us that the trend is likely to continue or that it's likely to reverse. We're using momentum indicators for divergence, and then our trade management is really based on what you see in the upper portion of the screen. So I'm going to go through and show you some of our actual trades. The first trade was on 12/27. We took a long in the ERX, and it stopped out for a 4.5% loss. That's about the max loss compared to the other markets. So like for our intraday ETF alerts, we trade 6 markets, 3 off 240-minute time frames, 2 off 120-minute time frames, and 1 off of a 180-minute time frame. That way we're kind of spread across different markets, different sectors, and different time frames, and we're almost always in something or having trades set up. So we got a long signal here. The ERX will have our biggest stops of any market. If you're going to trade the ERX, you have to have a strong stomach. It has huge gaps in it at times, but it also can give you huge winners. So we had a long signal that lost here, and then we had another long signal, a much stronger long signal on the 31st, and it went up. By the end of the day, we're moving our stop up to above break even and into profit. So here's our first stop adjustment. And what I'm using there to assess that is it's come up into the 20-period EMA and the midline of the Keltner, which is the 20 SMA. And this halfway point between our outer band and the center line, this Keltner at 1.25, the dotted yellow line, we're using that because that's going to be an area of support and resistance. So we're using that for a stop adjustment. We're into profit. The next day, it gaps way up. We actually get an exit signal, and we take half off of the 9% profit and move our stop up now again using that next center point because it's gone outside our 2.5 Keltner channel. So we're moving our stop up right under the 1.25 Keltner. And we're just going to keep moving that stop up every day as long as it's trending. We get a full exit signal here, 15%. So again, the blue is the midline of the Keltner at 20 SMA. The green is 20 EMA. And then these are Keltner channels, 2.5 and 1.5. And they give you a wonderful implied trading range for the market, a wonderful way to measure stops and adjust stops. And you'll rarely see something trade outside that Keltner channel for very long, except when you're in a strong trend. And we'll show it here. So trader's mentality, now we took our profit, we're stepping aside. We don't really care what the market does after. We just want to look for the next setup. And we get an absolutely gorgeous trend continuation long signal based on hidden divergence here. It was confirmed by all of our trend indicators. So we take our long here. It gets up to the Keltner channel, and this angled line is we are just first using the 20-period EMA, move our stops up, and then when it's way outside the Keltner, we're just moving our stop up all the way with this trade until we get a final exit signal here 7 days later for a 10% gain. That's about all we're interested in a 7-day trade at max, especially with the ERX. Well, you know, we kind of got suckered out of the trade, right? It kept going up, but we don't care. We're approaching this from with a total trader's mentality. When we get our exit, we take our exit, or we might take half off and keep riding it with the stop moving up continually. The lower panel is the 533 stochastic, which is one of our momentum indicators that we use. So it's it's a fast stochastic, but we are only using fast D, so we're getting rid of the faster of the two lines, fast K, so we're using the slower of the two lines, the fast D at a 533 setting. So we take another hidden divergence long signal here. Our initial stop is right below this price pivot, about halfway up between this 1.25 Keltner and the 20 EMA, or the midline of the Keltner, the 20 SMA. And as soon as it's moving up our direction, we're using the 20 EMA for stop. It didn't go high enough to get it into profit, came back down. And you can see with the ERX, it'll gap away against you. But we had moved it up, so this is only about a 2% loss. It's not bad trade. Get another long signal, same type of hidden divergence trend continuation signal, and we get an exit signal right up here. Looks very toppy, and we actually got a short signal. I'm not showing you the ERY trades. We actually went long the ERY. And the ERY came down, and we had our stop in profit and stopped out, and then we got another long signal on the ERY. And unfortunately, I only have the ERX chart. And then finally, I want to show you a trade that we actually exited today. I think we might have got suckered out of the trade, but we don't really care because, you know, we got a nice profit on it in 2 days. Total trader's mentality. We went long right here a couple of days ago. I actually had to text out right before this our exit to our clients. I know a couple of them were in here. I hope you guys got it okay. So we went long. By the end of the day, we're moving our stop up. So here's our initial stop. We're reducing risk with the trade. Again, we're using that 1.25 area of the Keltner to make our stop adjust. The next day, it goes up as soon as it gets into the midline of the Keltner, the 20-period EMA. We're moving our stop up slightly into profit. And as it keeps going up, we're moving our stop up. And then yesterday, we started using the 20 EMA really, because if you look back through a strong trend, the price almost always will bounce off the 20-period EMA. It's a very good area of support and resistance in a trend. And this looks like it might be a trend now. But we did get a weak exit signal here, and so we took it today for about a 5.5% profit because we always are approaching these leveraged ETFs with the trader's mentality. Quickly reduce risk, use stop management to ensure profit, take profit, and look for the next trade setup. So how do we determine where to move our stop losses to? Okay, in the case of this trade, so I'm going to spread this out so we can just really look at this one trade. And again, we don't want decay to affect us. We're short-term trading these things, 2 or 3 days. You know, 7-day hold is actually really long for us. Although occasionally off the 240-minute charts, we might have a 2-week hold. But, you know, off a 120-minute chart, that's a pretty long hold for us. So we went along at the conclusion of this candle, and at the end of the day, it had moved up a little bit. But it had got over that 1.25 Keltner, so we're using that slightly below that for our stop adjust. So that's our first stop adjust. Now we only have about 1% risk, 1.5% risk overnight. And it came back down the next day, didn't go below that, kept us in the trade, and it shoots up. And as soon as it gets to the 20-period EMA, because it may flip back down there, that's an area of support and resistance. So we're moving our stop up about halfway between the yellow and the green line, and just a little bit lower to give it a little room. So it's well into profit now. And then as it goes up by the end of the day, now we're going to use the midline of the Keltner, which is 20 SMA for the stop. And then once it breaks up again, Now we're using the 20 EMA for our stop. If this had got up, so we exited this today for 5%, it went up another 2%, so we kind of got suckered, now it's rolling back over. Who knows where it's going to be in today. We're also long some other markets from some longer time frames, so we don't really care. We want our profit on the ERX. The year to date, we're up, I think, between ERX and ERY about 35%. These are all, our clients taking these trades with us. So we're on track, for another 120% year, which is kind of what the ERX, ERY tends to do. It's a really, really great pair to trade, but you have to trade the short term on it. You can't let that decay in the derivatives impact you, and you need to use the momentum to your advantage, which is the triple leveraged ETFs will actually go farther than the sector in a very short period of time, meaning 1 or 2 days, simply because of supply and demand in the open market. And then it's that asset value NAV will really catch up to it as institutions try to balance things out. So anyway, that's kind of a look at what we're doing with the ETF market. I hope you learned something about a really good way to trail ETFs and use your stops. If you have any questions, please feel free to email me, Brad Powell at rightangletrading.com. We are not publicizing it yet, but starting next week, I'll make sure you get an invite. We have our intraday ETF service, which is just text-based, and you get an email, but we send it straight to your phone through an SMS service. I get them on my phone. It takes less than 30 seconds to get the delivery. We give you a warning message about 20 minutes before a trade, so you can be at your computer at the top of the hour. We take the trade, and then we manage the trade all the way through. So far, we've had overwhelmingly positive response from clients the last 3 months. They absolutely love it. We're gradually adding more people to the service, and we're going to give anybody who wants it 21 free-day trial, absolutely no cost to you. Trade along with us on paper. If you like what we're doing, you may not like the way we trade. You may not like it. It may not be right for you. I know that. But, you can try it out for free. And if we had a bad, choppy, slow period or a little bit of a drawdown, because we do have drawdown periods, you're always going to maybe hit a choppy market and have a couple of losers. We'll give you another 21 days for free. We suggest just trade along with us on paper. Don't risk any of your capital. It's free to you. It doesn't cost you a penny. Trade along with us. If you like what we're doing, then you can subscribe to the service, because it's something, this is really where our focus is going to be, because, you put a ton of time and effort into training people and selling them a course and doing webinars and teaching them, and ultimately half of them come back and say, boy, I wish you would just tell me exactly when to take the trade. Well, thanks to text and SMS technology, now we can do that. So we're really excited about it, and our clients are really excited about it. So shoot me an email if you'd like to try it out. We're opening it up next week. We're in, 2 longs right now. We exited one today for a profit. The last few weeks have been kind of choppy. We've been squeaking out some very small profits. A lot of whipsaws that have been going back and taking us out on our stop adjust. But, we're doing pretty good. We're getting through. As soon as the market opens up, either a big move up or down, we'll be on the right side of it and be there for it. And the great thing is, off these shorter time frame charts, you can get a lot of trend continuation trades. So just a reminder, as I showed you with the SPY, leverage ETFs, bad investments, great for trading. Thanks for coming today. I hope you learned something and enjoy it. And Morgan, thanks for having me.
Great. Well, thanks again for being here with us. We appreciate you, Brad. And again, we are recording all of these sessions, and we'll get copies of the recordings posted on our website, hopefully by tomorrow afternoon. So at this time, I'm going to turn it over to our next speaker, is Jim Crimmins from Traders Accounting. And Jim, we appreciate you being here, being a great partner. Give me about 1 second. I'm going to get Jim